morning and welcome to this week's Market Carver. I hope you've had an outstanding week. If you haven't seen, the market's not having an outstanding week. Everybody waiting in anticipation for the Wednesday delivery of what the Federal Reserve is finally going to do. Market is still betting that there's going to be a raise. Again, we think there's probably going to be a decline in what their long-term view is and a potential small raise. In the meantime, markets really don't like it in a lot of different ways. And in fact, when you look at the economic backdrop, a lot of this looks very, very similar to what we saw in 1937. So we're keeping a close eye on watching it. Currently, the trends still remain bullish. Even though the feeling remains a little bit tumultuous inside of our stomachs, and I'm sure that's the case across the board. What I do want to deal with the Federal Reserve, because obviously when you see this on Thursday, we'll already have had the decision, and we're taping it on Monday. What I do want to talk about is the inflation chart and the expectations that you're seeing on the page. It's very interesting whether you're looking at the Euro region, the United States, and even Japan. You can see the chart with the pretty little colors is showing what people believe the inflation projections are going to be. And most of the world banks believe that that number is near 2%. What you can see in the gray shadowed area, I hope, is that we really are in a flat to deflationary environment. And what we're really seeing is much closer to a 0% rate of inflation than we are long term, or than we are as their expectation of the 2%. Interesting thing about bankers, the Federal Reserve and the like, they are very, very concerned about hyperinflation. They want to keep it under control, but they also loan money against assets, and so they do want some inflation. They would just as soon your house go up a little bit in value. It gives them a buffer against the loans that they've made. So it's kind of an interesting thing. The one thing they don't want is deflation. They're going to continue to talk their books to try to convince people that inflation is actually out there. Sometimes it doesn't pay to know. We all understand the cybersecurity deals. It was just a year ago when we were dealing with the health company that lost all of our data, Target and the credit card thing. You saw all of these companies come up with cybersecurity issues and rules. There's even a couple exchange-traded funds, one of them called Hack, and yours truly really looked at it and would like to buy it. It's part of why we have our process, though, with a four-legged stool to make sure that we don't buy things ahead of time. 2015, watch cybersecurity budgets grow by about 5%. That's good. Top line earnings growth, we're not seeing that in a lot of places. But in 2016, CIOs actually thought it was going to go up 8%. And yet, the stocks in those areas are continuing to work their way down. Glad we're out of that space, but clearly something that we watch all of the time. We've talked a little bit about bonds, especially with the Federal Reserve and things that they're doing. I'm going to try to give you an example of that right now, just so you can understand what is happening in the high-yield bond market. And even though it's not as exciting as stocks, and you may have not heard about it on the local newspaper, believe me, the conversation about last week to professionals was not about stock markets. It was truly about what's going on in the high-yield interest environment. By high yield, we mean bonds that have been marked down to junk or so forth. So 2009 was a wonderful period of time to get into the high-yield bond area. We certainly did in a few different exchange-traded funds. But this year has been nothing but brutal. By the summer, and let's just look at Chesapeake, big oil company, not a Exxon size, but a big enough company. By the summer, the bonds were trading at about 0.8% or a 20% haircut or discount, if you will. In the last few weeks, that number has gone down to 30 to 40%. So you're talking about a 60% discount on some of those bonds. And in fact, they're now actually giving a new offering to try to shore up some of this pain that is actually occurring. In many of the reviews we had over the summer, we talked about watching to make sure these companies aren't defaulting. The chart that you're seeing will actually show you that even though the defaults are starting that tick up, that trend, and we really want to keep close of it, compared to defaults we saw back in 2007 and 2000 and other periods of time, we're still nowhere near there, but we are keeping an eye on it. Last but not least, we want to talk about relative value. You know, everything is a comparison. What is the appropriate price for something that needs to be where it should be? And what you're seeing on this chart is a comparison of the S&P 500 versus commodities. So if the market's going up and commodities are going down, you're going to see a swift rise in that line, what we would even call a parabolic rise, if you will. We saw that in late 1999 in the tech wreck as stocks screamed higher and commodity prices were stuck to actually declining. As you can see, a big part of that is oil. We all know what's going on in the oil industry as we go by the gasoline and the stations right now, to see the price of gas continue to go down and the price of stocks going up. When you see that parabolic move, what it tells you is either the market has to come down or commodities have to come up, or a combination of the two. We've talked about this on the radio show quite a bit, and we'll continue to talk about it here and as well on the reviews that we have. If you're out and about on Saturday morning, don't forget to catch the radio show 9 to 10 on WQME. Saturday mornings 10 to 11 on Shine 99 on Sunday morning, and of course you can find us on Wilo Thursday afternoon to 4 to 5. As always, if there's anything we can do to be of service, please don't hesitate to let us know. Take care of yourself. Enjoy the Christmas festivities. It's hard to believe that it is this time of year already, but it really is. Get your shopping done. God bless, my friends. Have a great week. We'll see you again soon.